Hello everyone, I am Dr. Geetanjali Shreevastav from the Department of Commerce at the Bhopal School of Social Sciences. And today we are going to discuss about the banking. In this module, I am going to take up the few topics, that is the concept of banking, the definition and the functions of a bank. The word bank is generally used for the commercial banks. We have two banks. One is the Central Bank of India, that is the bank which prints the money and which make the monetary policies, controls the credit, also issues the guideline for the creation of the credit, and the commercial banks also, which works under the guidance of the central bank. In India, our central bank is the Reserve Bank of India. So, the word bank is generally used for the commercial bank. This word has been derived from the French word banqui and the Italian word banca. This means the bench. Earlier in 14th and 15th century, the bench was the center point where the money lenders and the merchants used to sit nearby the market, and they do all their money lending, cash exchange and the banking transactions through this bench only. So, this was one of the sign where the banking transactions used to take place. So, this bench means keeping or lending or exchanging of money or coins in the marketplace by the lenders or the money changers. Now, let us see the definition of a bank. Bank is an institution which collects ideal money temporarily from the public and lends to other people as per need. So, what we see here, the bank has two functions. One is accepting the deposit from the public and giving the money to the borrowers. So, according to the Banking Regulation Act 1949, banking means accepting for the purpose of lending or investment of deposits of money from the public, repayable on demand or otherwise, and withdrawal by check, draft or order otherwise. Here you can see this word, that the banking is accepting the money for the purpose of lending and for the purpose of investment. Bank invest our money also, and in that we get some kind of interest and get good returns. Then the deposit of money from the public, whatever the depositors are depositing their money in the bank, has to be repayable as and when demanded by the public. This can be in the form of the direct withdrawal, maybe through the ATM, maybe through the checks. So, the bank should always return the money as and when demanded by the depositors. Now, let us see the functions of bank. The functions of bank have been categorized under two categories. One is the primary function, second is the secondary function. In the primary function, we have first accepting of deposit and second granting of loans and advances. The first is accepting of deposits. In accepting of deposit, the first category is saving deposits, which encourage saving habits among the public. It is suitable for the salary and the wage earners. The rate of interest is low, like suppose we open the bank account in the bank. So, usually all the households get this facility to open the saving bank account wherein the interest rate is low. The account for saving deposits can be opened in single name or joint name. The depositors need to maintain a minimum balance that varies from bank to bank or according to the guideline of the RBI or the commercial banks. The bank also provides the ATM cum debit card facilities, checkbook and other internet banking facilities. The second is the fixed deposit. The bank also encourages the public to deposit the money to the bank in the form of the fixed deposits, which is also called as the term deposits, and popularly it is known as the FD. So, money is deposited for a fixed tenure. Say for example, you are depositing your money for 5 years or 10 years in the bank, and this money is locked with the bank, which gives the liquidity. Also, this gives a good rate of interest to the depositor. So, when the term is fixed, no withdrawal of money during this period is allowed. Bank levy a penalty for premature withdrawal in case depositor withdraw before maturity, as a lump sum amount is paid at one time for a specific period and the rate of interest is high but varies with the period of deposit. So, as long as you maintain your FD, you keep a long tenure of your FD in the bank, you get good rate of interest, and the moment you break your FD or make the premature withdrawal, the bank imposes certain kind of charges to discourage the depositors to go for the premature withdrawals and to break the FD. The bank levies the charges or they deduct certain amounts so that the depositors will refrain themselves from withdrawing their FD. The next is the current deposits. This is also one of the form through which the bank gets the deposits. Current deposits is basically for the businessmen, wherein they do not get any interest on that as the depositors of the saving bank account used to get, but they also get many facilities like the overdraft facilities or the cash credit facilities, and this also gives lot of liquidity to the bank. So, this is opened by the businessman. The account holder gets an overdraft facility. Now, what is overdraft facility? It is a short term loan to meet the urgent needs of the businessman. The bank charges a high interest rate along with the overdraft facility charges to maintain a reserve for unknown demand for the overdraft. The next is the recurring deposit. In recurring deposit, a certain sum of money is deposited in the bank at regular interval. Money can be withdrawn only after the expiry of a certain period. A high rate of interest is paid on recurring deposit as it provides the benefit of compounded rate of interest and enables depositor to collect a big sum of money. This type of account is operated by salaried persons or traders. So, whenever you are going to deposit certain sum of money on regular basis, monthly basis, say for example for 2 years or 3 years, so you get the compounded rate of interest, and also this again increases the liquidity of the bank, and it also gives the motivation to the borrower. Now, let us see what is granting of loans and advances. In primary function, the second sub function is granting of loans and advances. Now, the deposits accepted by the public are utilized by the bank to advance loans to business and individuals to meet their uncertainties. Bank charges a higher rate of interest on loans and advances than what it pays on deposits. The difference between the lending interest rate and interest rate for deposits is the bank profit. Now, as we discussed earlier, the primary function of the bank is accepting the deposit. In that, we have seen accepting the deposit through the saving bank account, current account, fixed deposit account and the recurring deposit account. Now, let us see how the bank advances the loan. So, here what bank is going to do, the deposits accepted by public are utilized by the bank to advance loans to businesses and individuals to meet their uncertainties. Bank charges high rate of interest on loan and advances than what it pays on deposits. Let us see the example here. This is the bank. Bank is accepting the deposits from the households, corporate houses, then the government and the foreign institutions and the foreign investors. These are the persons who are depositing their money to the bank. Now, what bank will do? Bank will give this money in the form of the loans and advances to the borrowers. Now, borrowers are going to pay this money with some rate of interest. So, some part of the rate of interest the bank will give to the borrower. Say for example, the bank is charging rate of interest of 20%. So, bank will keep 12% with them and bank will give 8% to the borrowers. The remaining this 12% is the income of the bank. So, as you can see in this line that bank charges a high rate of interest, that is what the bank is charging, the high rate of interest, let us say of 20% on loans and advances. Then what it pays on depositor, the bank is actually paying 8% to the depositor, the remaining 12% is the income of the bank. Now, let us see what all are the various forms of the loans and advances. The first is the bank overdraft. This facility is for the current account holders only. Now, what all are the current account holders? Current account holders are the businessmen who used to open this kind of account with the bank, and at times there may be the possibility they are in the urgent need of the money, and that cash balance is not available in their bank account. So, what they do? They take the overdraft facility. This facility allows holder to withdraw money anytime more than the available in the bank balance, but up to the provided limit. Let us take an example. Suppose X is a businessman who has at present having the 5 lakh in his bank account, but he has to make some urgent payment to some vendor and he needs 7 lakh to make the urgent payment. So, he can withdraw extra 2 lakh from the bank. This is called as the bank overdraft facility. So, an overdraft facility is granted against the collateral security. X needs to maintain or keep certain kind of collateral security with the bank. The interest in overdraft is paid only on the borrowed amount for the period for which the loan is taken. So, obviously, say for example, he can withdraw up to rupees 5 lakh, but he has withdrawn only 2 lakh. So, whatever the amount actually he has borrowed from the bank for a particular time period, so he will pay the rate of interest on that only. So, this is the one kind of the loan and advances, that is the bank overdraft. The second is the cash credit. It is a short term loan facility up to a specific limit fixed in advance. Bank allow the customer to take a loan against a mortgage of certain property. Now, to avail the cash credit facility, the borrower has to guarantee something or has to keep something in the tangible form with the bank. The cash credit is given to any type of account holder. So, this can be given to the household person or maybe to the businessman, and also to those who do not have a bank account with the bank. Interest is charged on the amount withdrawn in excess of the limit. Through cash credit, a larger amount of loan is sanctioned than that of an overdraft for a longer period. So, cash credit is a facility through which whatever the amount you are taking for some purpose, on that only the bank is going to levy or charge the rate of interest. Then next is the loan. Loan is something which can be the short term loan or can be the long term loan. It is available in short term, it is usually available for 1 to 5 years, and for long term loan these can be up to the 10 years, and the borrower repays the money either in the lump sum amount or in the form of the installment. Say for example, you want to buy a car or you want to buy a vehicle or something like that, you have taken a lump sum loan from the bank. So, bank will immediately, the moment it disperses the loan to you, bank starts charging the rate of interest, and you can pay back the money to the bank in the form of the lump sum payment or maybe in the form of the installments. The interest rate in the loan is lower than the overdraft and the cash credit facility. Here one more point which is very important to know, that the bank charges interest on the actual amount of the loan sanctioned, whether withdrawn or not. So, say for example, you have taken a loan of rupees 35,000 and you are not utilizing that money, then also the bank is going to charge the rate of interest for that loan. The last is discounting the bill of exchange. Now, we all know that all the businessmen used to maintain the books wherein they have the bills of exchange, where they have the bills receivable. When the credit sales happens, they used to have the bills receivable, which is an asset of the businessman, and they are going to get their money at maybe in the 3 months or 4 months. So, what happens is, say for example, that businessman who has the bills receivable is in urgent need of money. So, they can present their bill to the bank and bank can give the cash to the businessman. So, this is called as the discounting of bills. So, you can see here it is a type of short term loan where the seller discounts the bill from the bank. So, whoever the seller is who has a bills receivable, he discounts the bill from the bank and the bank charges certain kind of fees for that. The bank advances money by discounting or purchasing the bill of exchange. So, the bank gives that money to the seller, it pays the bill amount to the drawer or the seller on behalf of the drawee by deducting the usual discount charges. On maturity, the bank presents the bill to the drawee or acceptor to collect the bill amount. So, what we have seen here, what all are the forms of the loans and advances? Number 1 is the bank overdraft, number 2 is the cash credit, number 3 is the loan, and number 4 is the bill of exchange. Now, let us see the secondary functions of the bank. The secondary functions are the agency functions and the utility functions. As we all know that the corporates used to open their bank account with the bank. Now, the bank becomes the agent. There is a principal agent relationship. So, the banks are the agents to their customers. Hence, it has to perform various agencies. So, it can be the household, it can be the government or the companies. So, what all are the following functions bank do on behalf of their customer? Number 1, transfer of funds from one branch to another branch. This can be the RTGS or the NEFT. There can be the periodic collections on behalf of the client. There can be the periodic payment like the rent, electricity bill, etc. Then the collection of checks can be done on behalf of the customer. Next is the portfolio management, where the bank manages the portfolio of their client. This is related with the purchase and the sale of the shares and maybe investing the customer's money into the mutual funds or into the direct capital market. And the next is the agency functions. The last is the agency functions, under which the bank works as the executor, trustee, administrator or the advisor of the client. And the last is the utility functions of the bank. In utility function, the bank issues the letters of credit, traveller's check, etc., undertaking the safe custody of valuables, and for that the bank gives the locker facility or the vault facility to the customer. The bank also provide the customers with the facilities of foreign exchange dealings, underwriting of shares and debentures, and dealing in foreign exchanges and investing in the foreign market. Then bank also does the social welfare programs like the CSR activities. They make the project reports on behalf of their customers, and they also provide the guarantee letters to their customer if suppose they are working with the some projects or they are working with the foreign market, maybe related with the exports and imports. So, this is all about from my side. I think the concept, the definition and the primary and the secondary functions are clear to you all now. Thank you so much. Take care. Happy learning to you all.